Yes. Okay,
Okay.
Linus, over to you.
Thanks very much, Tim, and nice to see some names there, no faces of old shipmates and friends that I recognize. Thanks for the invite. My plan is to spend really about 8 to 10 minutes just talking about some things and leaving it more open for questions and answers because everyone has a different point of view of how they see the world in today's times. So I'm pleased to have Derek Ralph, my associate, with me this evening. Derek is actually a U.S. citizen and perhaps can shed some light if you have a particular question that might involve that. Um, yeah, so thanks again. And, we're a fiduciary discretionary investment management team that's supported by a whole bunch of BMO folks. And that's where we get our information, part of our forecasts and our ideas from. And so, it's just not me, it's all of BMO that's coming to talk to you this evening. We're currently, from a forecasting point of view, anticipating a 10 to 12% return on North American markets for 2025. We're in our third year of normalizing the economy and earnings after our COVID shutdown. We see a low probability of recession. We see current corporate earnings continue to grow. Interest rate policies are favorable, with the anticipation of 1 to 3 cuts here in Canada and at least one cut probably in September from the US. Inflation is currently steady, not progressing down as much as we would like, but it is going in the right direction. And of course, tariffs will always may have some influence on that in the future. We see reasonable valuations for many companies, not all of them, and we actually prefer dividend growth strategies to generate returns this year. Now, I've given you a rosy picture. There's obviously a number of risks. Trump 2.0 and tariffs. Should the full tariff wrath be unleashed, we expect a large GDP cut in Canada down to zero and probably force the Bank of Canada to cut between 1 to 2% interest rates for economic stimulus. I'll have a little bit more about that later. The US is richly valued, much more so than here in Canada when it comes to the price earnings and other metrics that we use to value stocks. And, when you benchmark against the S&P 500 as an example, the top 10 companies make up a third of the index. So you have 10 companies largely responsible for, the return of the entire index. We see the Canadian dollar, currently about 70 to 70 and a half cents, was down to 69 cents 2 weeks ago when we had tariff mania. I do anticipate that the dollar will continue to weaken relative to the greenback, largely due to productivity and economic growth concerns, plus the differential between the interest rates offered here in Canada versus higher interest rates in the US. Oil is a little bit of a wild card. It's a very fluid situation, pardon the pun, but things are changing on a daily basis. We anticipate oil to stay between $70 and $90 a barrel, largely because of a tighter supply constraint. We like gold as an investment. It recently broke above $2,800 US an ounce. We anticipate at least 3,050 in the next year, and it may happen sooner. Tonight, it closed about 2,950. We're neutral to negative on most commodities, but if we want to own commodities, we prefer uranium for power and copper for potential Chinese stimulus, or just general economic growth and the electrification of the world. So on tariffs, should 25% tariffs be placed on Canadian exports into the U.S., GDP could very well go to zero. We anticipate that a 1% recovery would happen in 2026 because the dollar will remain weak. We will have lower rates, and the government will definitely spur some sort of relief program.
Hey, Linus,
Yep,
just watching your slides here. You're still on, have you changed any slides?
I have.
Okay, I think we're all looking at the your opening slides still.
I'm not seeing it.
Okay. Let's
I
maybe.
suggest you unshare and then share again. There you go. Okay, we're up to tariff thoughts.
Okay, so there's the
Sorry.
part where yeah, so no problem. I was talking about our targets. There's talking about the dollar and gold and commodities. And of course, I will share this with everyone if you want. So, and, I was kind of just in the middle of talking about tariffs and our thoughts. An important distinction is that the Canadian stock market does not equal the Canadian economy. We're talking less than 10% of the, market is made up of steel, auto parts, and other things that would be subject to tariffs. So, although the economy would hurt, the stock market, as you've seen over recent times, has not been decimated by the thought of the Trump tariffs. You have a number of other sectors that make up the majority of the Canadian stock market, and the financial services being the largest of them. And I agree that they would suffer should we get into a recessionary time frame or the recessionary period. They actually have no exposure to any tariffs. Services aren't tariffed. The major banks have large exposures and large revenue generation, between 40 to 45% in the U.S. market, generating revenues in U.S. dollars, which flow back to Canada at very nice premiums. So there's a lot of good things to be said about owning Canadian financial services at a time like this. Let me know if that has changed. Did we get a change?
Good, you're on interest rates normalizing.
Okay. Unless I hear otherwise, I'll assume my slides are changing. If you look at the trend of, now this is the US 10-year Treasury note, if you look at the trend over the last 30 years until 2022, interest rates did nothing but go down. And that's the reason house prices did nothing but accelerate, because the cost of borrowing was going down, 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 inflating the values of potentially, residents and real estate. In 2022, that kind of all stopped as we started that first year of normalization, and interest rates rose rapidly to combat the inflationary experiences we had, and we got a big interest rate shock. And now, over the last 3 years, we've kind of stayed in that same band that you see outlined in green. And what I'm going to tell you is that, anything over 5% would be concerning. Currently, the 10-year rate's about 4.5%, which is in that normal range, if you will, that we can expect to have decent growth. But anything over 5% shows that the economy is indeed slowing. There's potentially increased inflation, and you're looking at a potential stagnation type scenario. So, we want to watch the 10-year interest rate, and as long as it remains under 5%, there's no canary in the coal mine that says that the economy is going into recession. Now, speaking of interest rates, early in January, we predicted what bond returns would be based on the fact that we thought that the Canadian bond market would, lower, or the Canadian Central Bank would lower interest rates 4 times. That's likely down to 3. So these bond returns could be a little bit high by about 1/4 to 1/2 point. But if you look at kind of 5 years out, you're able to get 3.5 to 4% on decent quality corporate and government bond returns over the course of the next year. And that's a nice place when things are tumultuous to clip a coupon. And if the Bank of Canada actually has to cut rates because of tariffs, then the value of those bonds are going to appreciate and you'll get a nice capital gain. If you want an explanation of how that happens, it's beyond tonight, but just remember, when interest rates go down, the value of your bond goes up. Another piece that we're watching is, unemployment, currently at about pre-COVID levels. Until it rises above 7 in Canada or above 5 in the US, central banks are going to be comfortable in maintaining the course and reacting to, the shocks that might come forward with lower interest rate cuts. At the start, I said I was bullish and we thought 10 to 12% in the markets. And this is why we've just completed nearly the, fourth quarter, quarterly reports from companies. We're still very comfortable with the outlook of our estimates. The companies that have reported decent outlooks for the most part. And, as estimates go and as earnings grow, so do the prices of the underlying stocks. I did talk and said that valuation matters, and you can look at the valuation of the S&P 500 versus the valuation of the TSX, a large differentiation between the two. And so, Canada is cheap, the US is expensive. There's a good bull case to be investing a little bit more than you might be used to in Canada just because of valuations alone. And I'll give you a chart in a second, or a description of how I think you should be looking at your investment philosophy. And so, our motto for 2025, sorry, is own a bit of everything. Think of it as a barbell approach, where on the left side of your screen, you'll see value, and on the right side, you'll see growth. Different themes and different reasons of why things are either in the value section or in the growth section. At the center of your investment portfolio should be a bunch of high quality dividend and dividend growth payers that kind of, I would say, form the core of your portfolio. And you use the value and growth sides to be satellites that you move in and out of, depending on what happens with tariffs, Trump's, Ukraine, China, you name it. There's many things that are affecting the world today, and each one of those things will react differently in the market. So own a bit of everything, be spread out across that barbell, and 85% of them should do well, 15 might not, but they're offset by outsized gains in the other parts. So, some general investment points, and, Tim kind of said, don't ask me a specific question about your portfolio, because every investor is unique. What you need to do is match your asset allocation to your own risk tolerance and level. How much do you want in stocks? How much do you want in bonds? How much do you want in safety? So again, own a bit of everything. Focus on dividends that grow, not the dividend of a stock. And the prime example of that is Bell Canada. Pays wonderful 12% dividend, but you've lost 30% in your capital over the course of the last year. So don't focus on the yield, focus on whether the companies are earning enough cash flow to create dividend growth for you. Own a bit of gold, own discounted bonds for tax efficiency. So if you have money outside of registered plans, so RSPs, TFSAs, outside of that, and you just have a cash investment account, buy a government bond that doesn't pay much interest at 95 cents that matures at $1, and you get that 95 to $1 as a capital gain versus interest, which creates more tax. And so I'm a big proponent of having discounted bonds if that suits you. Watch the 10-year treasury rate. 5% is that key. At 5%, I would be a lot less constructive on the market. If you need money soon, don't have it in the market. That's the point of having ample liquidity. And make sure that when we have times like this where the market is volatile, we don't know what's happening, that if you acquire income from your investments, and I'll give you a simple example, let's say you need $10,000 out of your RIF every year to fund your lifestyle on top of the wonderful military pension you have. You should have at least $50,000 to $60,000 set aside in GICs and bonds for the next cash flow for the next 5 to 6 years, so that if the market goes to hell in a handbasket, you don't have to sell any equity when it drops in order to fund your cash flow needs. So that you should do all the time. And our clients, we have a 5-year cash drawdown. Because the market did so well last year, we decided to take profits and added a 6 years. So I think that's a very prudent thing to do, especially as the markets gyrate around whatever the orange topped fellow says down south. So on that note, I'll stop there and open it up for questions, Tim, and thank you very much.